Our first speaker this morning, we're very fortunate to have because he's a busy man. He was telling me this morning that his schedule, he's almost the end of March. He's gone every week doing presentations. And his presentation today is on other crops. Most of us in the room grow other crops besides potatoes, so we're always interested in what's happening in terms of that market. So our first speaker this morning is Stephen Nicholson. He's the Vice President of Food and Agribusiness Research and Advisory Group at Rabobank. He has more than 30 years of experience in cash grain markets, hedging, commodity and ingredient procurement, commodity risk management, and commodity analysis. He's a native of Iowa. He holds a Bachelor of Science in Farm Operations and Agriculture Education and a Master of Science in Agriculture Economics from Iowa State University. Welcome, Stephen.
Well, good morning, everybody. Excuse me, I have a little water. First of all, thank you very much to United Potato Growers for inviting us back this year. And as I was preparing for this presentation, and I'm gonna have to change my bio, I was thinking about how long I've been at this, and it's been almost 40 years I've been in food and agriculture, and that's not including undergraduate. And you know, we've all been through the ebbs and flows of agriculture, and I came to the bank in January of 2014, so it's almost been 5 years. And in that time period, you know, I missed the big boom, if you have it with the bank, and now it's been sort of a, you know, a period of a more difficult time in agriculture and more challenging management decisions. So I kind of want to open that up and just say up front that we have to deal with that and we have to be honest about that. And I don't want to be doom and gloom, but I also, throughout this presentation, I want to talk about where the opportunities are, where are the things we need to do, and we need to be much more strategic about thinking where those opportunities are and how we manage our business and go forward. So like Mark doing his legal disclosure in the bank, we don't call it advice anymore, we call it coaching. Compliance people like that word a lot better. So let me get started and just kind of talk a little bit about the fields of uncertainty. And we're going to spend a bit of time talking about the macro look. Then we'll talk a little bit about wheat, about corn and soybeans, but we'll spend a lot more time on wheat. Corn is important because it does impact all of the markets, but we'll spend a lot more time on the wheat side. So let's start right into the macro side. And I'm thinking about the questions I get as I go out and talk to producers, and China is the first question that goes on. We are currently in Beijing having discussions right now with China. The markets have been a little bit happy and say, oh, we're finally going to get there, and not to put a damper on that, but one of the things that we've learned in talking to people at the USTR was very clearly said that don't expect anything to happen in the China trade wars until you see Robert Lighthizer there doing the talking. And in this discussion that they're having right now is kind of the second, I won't say the second team, but it's not the A team as they're having these discussions. And so when Ambassador Lighthizer is there, that's the person we want to see. Obviously, soybeans have been hit hard by that. Last time I saw potatoes hadn't been hit yet, but when you look at all the other crops that the U.S. ships overseas, particularly to China, they're all, you know, those export markets are dwindling. I will tell you, and as I say at the bottom, when we look at this, you know, in the U.S. here, our view is we have China exactly where we want them. I can tell you in talking to my Chinese colleagues, they have the same exact, we have the United States right where we want them, we're going to win this war. So I think we have to be very cautious and keep a perspective about where everybody is on this spectrum, and that we all have things to win and all things to lose in this. But the vast is we need to get together and figure this out because we all have things to gain by this. And as an economist, we think freer trade is better than restricted trade, and that's where we're at right now. Having said that, let's talk about global economic growth. And I'm going to point out a couple things. This red line is China. And you can see that their growth is going down. And that's what the markets, whether it's commodities or equities, is all worried about now, is that China's growth is contracting. China's going through, they're moving from a manufacturing economy to a consumer-driven economy like ours. So they're in this transition, which is going to be a little bit messy and it's going to be difficult. But think about if you're still getting 5% growth per year. If we had that in the United States, people would be jumping off buildings and being extremely happy. So don't get lost in the detail of, oh my gosh, China's contracting. Yes, they are contracting, but they're still growing. They still have 1.4 billion people to feed every single day, at least 3 times a day. So keep that in mind and don't lose sight of that. Now I do want to talk about, and we've shown this before, the green line is India, and you also see Southeast Asia down here as well. These are areas of the world where there's lots of growth. India in particular, they have over 1 billion people to feed, and Southeast Asia is where all that manufacturing has gone because of cheaper labor. And so those folks have more disposable income in their pocket. They're going to want to increase the value of their food on their table. So keep that in mind, and let's think beyond China, I think is the message there going forward. Don't forget China, but they're still there. We also talk about the dollar, and we think, oh my gosh, the dollar is going up because our interest rates are going up, which is part of the problem. And the fact is that the dollar, as it goes up, that hurts our exports. Now, the dollar index is important, but it is not what I want you to focus on. Think about our competitors in the world, and this is more of a grain and oilseeds competition than it is potatoes, because in potatoes you worry about what's happening in Europe primarily, also what's here up in North America. But when you look at Brazil, Argentina, and the Russian ruble, and you can see their currencies are devalued or devaluing against the U.S. dollar. Get that right. And I know this is upside down because the mark chart's going up. That means that there's more rubles or more pesos or more reals per dollar, which means their currency's devaluing against ours. That makes them more competitive in the world. They become the lower cost competitors in the world. That's what you need to focus on. And we'll just pick out Brazil quickly. Brazil's just got a new president. A lot of uncertainty around that. There's a lot of enthusiasm that he is going to correct their economy and correct their corruption. And so that's going to probably put that real a little bit in up and down. And so think about that from a soybean and a corn perspective. They're going to be extremely competitive in the world. One of the questions you always get on the trail is, what about interest rates? How far are interest going to go up? Now, this is the dot plot that the Federal Open Market Committee puts out. And you can see we're about 2.5, which is about right there right now. It's where we are. This is 19, 20, 21, and longer term. So you can see that the governors, when they put down on a piece of paper where they think they're going, it's only about 100 more points increase in interest rates. Now you're thinking, boy, we already had 100 points. I don't want another 100 basis points on my loans and so forth. And I agree and I understand that. My wife is thinking we need to move, and I'm thinking, no, I don't want to move because I have a good interest rate. But let's think about that and put that in perspective. Here's where we are today, here's where we've been, and here's where we've been over the long term. So in perspective, interest rates are not out of whack. We're still very low interest rates in the world, interest rates over time, I should say. And so that's a really important thing and something to think about. And again, keep in perspective. And I think that's one of the other messages throughout all of this presentation and thinking about your operation. Keep this all in perspective. So let's talk a little bit about the economy, and I want to just preface this that we are concerned about the U.S. economy. Obviously, the global economy shows some slowing down, but we're concerned about the U.S. economy. And if that disposable income gets a little bit tighter in the pockets, people don't go out and eat. That's not good for any of us, particularly those in the animal protein, particularly that potato on the side of the plate. They stay home and they eat at home. And so think about that in the sense of we have to not only promote potatoes at the restaurant level, but we also need to promote them at the home level and make them convenient there's great products in the store that I see in mine. But this is where the yield curve, and this is what people are talking about. This is the 2-year and the 10-year difference. And you can see we're heading to that 0 mark, or down here the inverse. And you can see the text up there. So we're probably someplace almost 18 to 24 months away from a recession happening in the United States. Could it happen before the 2020 elections? It's possible, but we don't know that. The yield curve is an extremely good indicator of, yes, there's going to be a recession. It's not a very good indicator in when. And you can see that it's a broad range of from almost 10 to 33 months when it actually happens. So something to keep in mind, but also watch it and watch the longer term. Here a couple, I think in December we talked about the shorter term ones. We went to an inverse. We need to look at those long-term and short-term bonds, not the real close, the real close ones. Here's real domestic gross product. It looks good. GDP looks good, or GDP looks good. And so you can see, though, the thing is that we are in a good spot, but keep in mind is we've been at a fairly steady rate area since the 1980s. We don't see a lot of volatility. So that's sort of the good news, bad news. But the volatility keeps the economy on a level playing field. But you can see we're in the longest expansion we've ever been. We're over 10 years now, and that's, as an economist, you look at that and look at cycles and think, okay, how much more is there? And one of the things I was taught early on by economists is we are an economy that's extremely strong, and it is hitting on all 8 cylinders. And as we all know, with any car or any mechanism or any machine, you can't improve on perfect. And so there's bound to be a little bit of a setback, and that's where we need to think about and kind of be prepared for that. Couple things, and we'll move to commodities here quickly. You can see housing starts have come up. That's the good news, but look where they are they're about where they were during the recession, and they've kind of flattened out. The housing market is a huge market that drives the economy, and if it slows down, the economy will slow down. Same thing with autos. Think about your auto and all the pieces in an auto and trucks and tractors, all the things that go in there. It's a huge supply curve. You can see they've come up and they've flattened out. You can also see when you look at light trucks, both foreign and domestic, they're going down and back at levels just during the recession from a sales perspective. Those slow down, and we see what General Motors and Ford are doing. They're cutting back their lines, and we can see, and General Motors is consolidating plants. So you can see they're trying to prepare for the next phase of the auto industry. So now we'll start to look at acres. This is where the market is going to start to focus here very, very quickly. We definitely see an increase in corn acres. We are currently working on our econometric model to look at where we think that number will actually be. It's probably someplace in that 1 to 3 million acre. It's a wide range, I know that. Beans, on the other hand, you're going to see a pretty big downdraft in beans. There are people talking upwards of 8 million acres of bean acres will be lost this year. Or not lost, but will not be planted. Now that's going to be dependent a lot on the weather. We had, as one of our speakers right off the bat, we had a horrible fall. A lot of field work didn't get done, so we'll see where that all falls out when we're said and done. We do expect to see a little uptick in wheat price and wheat acres. Wheat prices are not terrible, and people are making some money. They're going into this in hard red wheat country. It has good moisture this year going in, so we expect we should have pretty good hard red winter wheat crop, but there's a lot of season yet to go along. One of the things I want to talk about, and we'll see this in corn, is talk a little bit about where we are in the global grain supply. You hear a lot about, boy, stocks are down, corn is tight, why isn't corn higher, and on and on and on. So I want to just sort of talk about that and again, put that in perspective. This is corn, wheat, and soybean global stocks. That doesn't look like a very small number to me. This is the total supply number, so this is production, beginning stocks, and not imports, but total supply right there. So you can see total supply is very strong, is very high, and you can see that global stocks are high as well. You know, corn stocks are down in the world, but look at wheat stocks and look at soybean stocks. We still have plenty of stuff, as I call it, in the world. We're not running out of anything anytime soon. Yes, it is a contraction, but from a very high level and still remaining at a very high level. So let's talk about wheat. I'm not going to read these to you. You're probably more literate than I am. Economists, you know, we just deal with numbers. We can't read very well words. But let's talk about where the opportunities are in wheat. There are challenges in wheat, and each class has its own challenges. But one of the themes in the wheat market outside of these walls is protein. We did see better protein this year when you look at hard red winter wheat. But one of the challenges for your end user, your flour miller and your baker, is getting the proper protein and getting the blend of flour that they need for their products. And this has been a challenge that's ongoing and is going to keep going forward. And for the opportunities are for those who want to talk about and get closer to that end users, can you produce a wheat to a specification and bring that protein home so that they are not going out and searching for wheat? I can tell you stories about bakers in North America who the management is saying, why is my flour price going up when the wheat price is going down? And the procurement people come back to them and said, well, I have to buy wheat out of the Great Plains, hard red winter wheat, but then I have to go north to hard red spring wheat up in potato country to get the protein level I need and ship them in, and so it's increasing my cost. And management's just going, I don't get this. So it's the nuances of wheat, and I think there's where there are opportunities in wheat going forward. Here's the all wheat balance sheet, and it's a lot of numbers. It's still very high. We're still just under a billion bushel carry out there. We're still running 45 to 50% stocks to use ratio, so we still have plenty of wheat in the United States. Exports, we'll get to that in a minute. Exports are going to be decent, and there's some optimism that that number could be a little higher as we go forward, but we'll have to wait and see. When we look at our econometric model, and we need to, and as I say, we're updating this right now, we look at all wheat prices over the 10-year baseline of that forecast in that 5 to 5.20 area. This is national average all wheat price, farmer received price. So keep that in mind. We don't see huge dips, but we also don't see huge upside here because the production is there, and globally we have lots of wheat in the world. We will look at wheated acres, and I mentioned that up front, and this is kind of give you an idea where we think those boundaries are. We do see wheat acreage over the next couple years being a little higher, so keep that in mind when you look at it from a price perspective, and we'll come back to that. And then we do see wheat continuing that trend of downward acreage. And the reason for that is that, one of the things, and this has happened across all crops, we're becoming more efficient. You are becoming more productive. Yields continue to go up, and they sort of offset that decrease in acres. And so that's something to keep in mind going forward, is that it just is unbelievable the productivity that we can get, and that acres will probably continue to decline in wheat. Here's hard red spring. Hard red spring saw a big year last year. We see some of the largest Indian stocks we've seen about 4 years. And so we do expect that price is going to be closer to probably 5.25, 5.50 as we go forward here in the 18-19 year. But the fact is, we'll see how this year comes. With a little bit pressure on those prices, we may see wheat prices come down in hard red spring country, but basis levels continue to be okay. But when we look at the export market, they're depressed. The other market is also very viable for the wheat, for potato country, as I talk about the P&W, is of course is white wheat. White wheat numbers it's very low. Stocks to use is low. Stocks are low. That's a market that looks like probably has some upside potential closer to that $5 area as you go forward. So think about, for those of you who produce white wheat, and think about putting forward getting some marketing done early on. And let me just stop there and talk a little bit about. Let me go back to that just for a second. One of the things we are encouraging producers to think about is, in history, we've always sold the crop after we get it out of the ground because we have a hold up and get it. So let's step back for a second and think about, let's sell that crop before we plant it, because that's when the opportunities are. Think about where the corn market is right now. It's over not red Dees now, new crop Dees, December 19 corn is over $4 on the board. Would we like it higher? Absolutely. But there's an opportunity. I know the crop hasn't been planted, but let's think about selling some of that crop now versus waiting until we get it in the bin and go, yes, this is what we have now, we can sell it. Because as we look at all these markets are in carry, as we all know, as that front month drops off, the next month is going to go to where that month finished on the board, which is lower than the month that's going to come forward. So think about that going forward. What is that opportunity? I can sell stuff now at a higher price than if I wait later on when I harvest it. Talked about HRS. It is under pressure, and you can see that where it is, that circle is where Portland CIF basis levels are right now, significantly below where they last 2 years. I think it's going to be very difficult to get those numbers up until maybe as we get closer into spring. And we'll talk about why that is in a little bit. But think about the export market and who the big exporter is. Wheat inspections are good. We're running ahead of last year. We're running behind of last year, but we do think we'll pick up as we go forward, and we'll talk about that in a minute. Talked about protein, and you can see HRS had a nice year up here. Most of these are pretty flat. Protein levels are pretty flat. And I've had discussions with wheat breeders about, we have bred wheat for yield because that's what we've all been rewarded for. We get more yield, we get more money out of it. But the reality is that end user on wheat, and wheat's different than all the other commodities, it has attributes that the market needs, and that's protein. So how do we get the market, both from a breeder, from a market to reward producers to think about this? Let's reward for traits or specifications, and that, in the case of wheat, is protein. So something to think about. We've seen some improvements, but we need to keep making that going forward. Oops. So here is the global stocks. They're pretty high, so that's going to keep pressure on prices. But let's think about where those are coming from. That black bar in there that you can see, that's the Black Sea. This chart's even more dramatic. Here is exports by region. The black line is the Black Sea. That's where the challenge is. The Black Sea had less production last year, but they are still pushing wheat out the door as fast as they absolutely can. Now, the opportunity for U.S. wheat producers and Canadian wheat producers and Australian, although Australia has their issues as well because of drought in Eastern Australia, is as we get into spring, when those Black Sea supplies dwindle, they're not going to have any more wheat to produce. And that's probably where the opportunities come, so that when we look at that basis number for Portland, we'll probably see that number come up, and that's where the opportunity is. So be paying attention to what's happening in the Black Sea, or their export pace, and also paying attention to what that basis number is doing in Portland and at your local market, because that's going to tell you when the opportunity is to move. If the market's going up and it wants wheat, for example, that's when your opportunity. If someone's willing to buy, you better be willing to sell. So there's U.S., you can see, and I see a problem with my chart already. I'm going to have to get that fixed. But you can see we still have plenty of stocks in the world. So I've got about 10 minutes, so we'll talk about corn and we'll talk about soybeans real quickly. Again, here's the bulls and bears, as I like to talk about, and think about what's happening in those markets. Corn is going to be a challenge this year. Everyone's bullish corn, and I want to kind of let's frame this a little bit and think about the calendar. So right now, we have new crop corn at $4. It's a carry market, so as that contract moves forward, it's going to more reflect what that nearby crop, what that nearby number is, which right now is running around that 370, 380 area. So you've probably got 20 to 30 cents downside on that $4 if you look just at how the board is structured today. Okay, so now we're here in January. March 31, we get USDA Planning Perspectives Report, assuming the government opens back up. We'll get that number, and that number we believe is going to be higher than it was last year. So that's going to be negative to the market going forward. So okay, that's one calendar. The next calendar point is South American corn production. Had a drought last year, and we can talk about what's going on in Brazil right now. Is that when we look at, they got the bean crop in Brazil in good time this year. So there is opportunity that corn crop, that second crop, which is their biggest crop, is going to get planted on a timely manner and be a good crop. That crop will be harvested in June, July, in the middle of our growing season. So you have a time period right now in these first 3 months of the year probably to really have opportunity to market corn and get it done before you see higher corn acres here in the United States and a bigger crop in South America. And I'm not forgetting about Argentina because they're in good shape as well right now. So think about that as opportunity. And where in the calendar are the milestones that the market is going to be turning on, and what is your view of that milestone or those changes? Basis levels on corn in the country are very wide. Again, probably not an upside because the country has lots of corn and there's lots of corn in storage. Again, think about the calendar. As we get into spring and that stored corn gets a little hotter, a little warmer, and people need to move it to keep it in condition, basis levels will get a little bit soft. So keep that in mind too in your marketing. So there's the balance sheet, 1.7. I'm not going to delineate that. I'm not going to spend a lot of time on that. The fact is we do see a contraction stocks. We're about 12% stocks to use ratio, but that's not, we're not in a situation where we're losing acres. When we look at our econometric model and look at price probabilities, about a 70 to 75% chance that prices for corn at the farm level are going to be under $4 over the next 10 years. So keep that in mind as well. If you see that farm level price go up above 4, then you think you're in that top quartile where prices are probably going to be. Time to probably move some or market some. And you can look at this. This is looking at stocks to use versus price. There's the 12%, and you look at those two curves, you're around that $4 mark. That's about where, and this is looking at new crops, so we're looking at December forward. That's about where December's trading. So this seems fair that the market should be trading about $4. So again, think about there's an opportunity and the market's fairly trading. We probably ought to do that going forward. Here's Gulf SIF base on corn. You can see it's just about where it has been the last several years. Nothing too remarkable about that, but the fact is you can see, particularly when you look at 17, and 18 was a little more upside, but you can see that we're staying right in where we have been traditionally. SIF values have been a little more volatile, and we expect that to be the case this year as well. But when those opportunities arise, that's when you need to take advantage of them. I show this just to give an idea because people will ask the question, well, where'd all that demand go we had when this happened? Well, the problem was not the demand now, the problem is supply. Supply has caught up with demand. And as you can see, and I've had several questions about it, and people said we could just talk about this all day. But think about, this is back to 1900, and you can see the span of these periods of time around that 30-year mark. And so we're about 10 years into this time period where we saw the big boom and now we've come up. And you can see prices over time slowly deflate or slowly come back to the price of production before we get that next big turn in the demand curve. So we're probably 15 to 20 years out from another big move in the demand curve. It might happen a little sooner because we're more people in the world and those people grow faster now in the sense the population grows faster because you have more people, but think about that from a standpoint of planning long term and thinking strategically about your operation. Corn exports are doing okay. They're doing actually really, really well. They're up a lot this year because of what happened in Argentina and Brazil. They needed corn. But again, think about that calendar. As those crops get harvested during our growing season, that's going to put a lot of pressure on corn exports, the United States corn exports. This is where the issue, and we talk about this, here's U.S. in the blue. You can see our exports are fairly flat. We get some uptick. But look at where Brazil, and we look at the Ukraine, and that's where that opportunities, or where those, in the Ukraine is, I'm sorry, the Ukraine is in the orange, Brazil's in the green, Argentina is relatively flat. But Brazil and Ukraine continue to expand and take market share away from the United States as far as corn exports around the world. That's what we have to compete against. That's why we go back and we talked about the currencies and talk about those currencies in the world we're competing against. So we need to be on top of our game to move product out. Remember the big chart where I showed corn, soybeans, and wheat up front and we had global stocks? Here's the corn chart pulled out. You can see that stocks-to-use ratio is down, but you can also see this is still a very large stocks. Yes, they are contracting, but the fact is we have plenty of stocks in the world and no one is going hungry. If I would be more concerned about this chart if I saw basis levels going up. But basis levels are not going up. They're staying relatively firm in corn, or relatively stable in corn, and sort of at the lower end. So that makes a huge difference as far as where we go from there. We did see a major revision in Chinese crop, and I know my time is whittling down here, but I want to talk a little bit about this. We had a call with my colleague in China yesterday. If you look at the Chinese official numbers and what they're using, they're about 50 million tons difference or lower than what these numbers are. The Chinese have a huge issue coming on of wanting to expand ethanol. They want to expand feeding, domestic consumption, and I'm not sure how that's all going to work. That is bullish for the corn market, or friendly for the corn market as far as I look at it from a global perspective. But if we don't solve this trade issue, China will not come and buy any corn from us. They've never been a big corn buyer from us. They're just a little speck on the bar. But they're going to have a need, and we need to be prepared, and we need to be in a position to get back in better relations with them so there's not this animosity going back and forth. So there's what you see as far as the different feed grains as to what they're importing. You can see they're relatively flat this year and expect the same next year going forward. You can see the contraction in corn stocks on the bar. The blue is the average farm price, and you can see average farm price will be a little higher this year because we're seeing a contraction, but again, not a real big deal. So I'm dwindling down on time here a little bit, so I'll just show you a couple things on soybeans. We do see a move down in acres this year with the low price in soybeans. We focus an awful lot on China. That sounds like it's been a theme all the way through this. And we focus on the trade tensions. But I want to back off and think about this. When you think about what's happening in China and with beans, and I'm going to switch to the balance sheet because I want you to focus on that 955 million bushel number. Everyone has said if we could just remove the tariffs, the bean market would go back and everything would be fine. Short term, I think you're absolutely correct. About 2 days on the board, and the board's going to go back and think, oh my gosh, we got 950 million bushels of beans we have to find a home for. So yes, I gave you good news and I gave you bad news all in the same sentence. So let's go back and think about that good news. If the tariffs are removed and the bean market responds my coaching thing as compliance to say to you is, that's a time to move beans. And it's the same thing with corn and with wheat, because if we get the Chinese tariff thing resolved, we are going to see an upturn in the markets. And that is your opportunity to do something. The markets are not going to, because the stocks are so large, markets are not going to give us a lot of opportunities to the upside. And when those opportunities come, you need to take advantage and move on. Now, I'm going to say one thing. This is from a banker perspective. Make sure you understand what your costs of production are so that you know whether you're making a profit on that sale. But I want to encourage you to think very carefully about those opportunities, and when they come, take advantage of them. I'm thinking about them not from, is it going to go higher, but where is that opportunity going to come again? And I would caution you that probably those opportunities are not going to be very long in duration because we have such large stocks. As we dwindle down the time, as we look at 70% probability on prices, we're seeing them going to be under $10 most of the time. That's because we just have so many beans in the world, and we have huge competition out of Brazil and Argentina, particularly Brazil. When we look at that supply curve, when we look at that curve, we're way out here, and we're under $9 on the board. And this is November. This is looking basically at average of fourth quarter beans. So think about November beans. So you're under $9. So you're way, way out there on that right side of the curve. Here's Gulf basis levels. You can see we're below where we typically are. We're just about 20 cents. That's up from unders. In my career, I've never seen unders at the Gulf of Mexico for soybeans. That's just unbelievable. So that tells you how difficult the situation is. So let me show you, and there you see soybean inspections. You can see where we are this year. We are not even close to where we typically are. But let's show a couple quick charts here. This is the top 10 destinations for U.S. soybeans in 17-18 in the blue bar. And you can see there's China. They just outstrip everybody. These are the other 9, and you can see they're just a blimp on the record. And then the red bar is this year. And you can see China hardly shows up. The other ones are much more attractive. So now I'm going to flip this chart, and we're going to look at it if we look at the top 10 exporters for 18-19. So this is from the beginning of the crop year until now. We're still getting export inspections, by the way, so that's a good thing. So you can see the red bar is this year, and you can see the green is what was last year. And you can see we have a lot broader range of customers than just China. And that's a good thing in my mind. We're seeing more beans from Europe. Mexico has always been a good customer, and I don't want to say that, but we also are seeing more in South America. And you can see Argentina is huge there. But the other thing, too, is we're seeing it, and part of it is because of the drought. Argentina needs beans. We're seeing beans in Chile exporting beans to Chile. So we see some bright spots. And I think from a perspective of a bean marketer, we need to be able to cultivate these and keep these relationships going forward so that we have more than one market than China going forward. You can see Brazil continues to take market share away from it. This is the United States in blue. Brazil is in the green. And as Brazil continues to take market share away. And the tariff war with China has just accelerated that process. And that's discouraging. We don't want to ever give up market share. And we've given a lot of that up to Brazil over the years. Let's talk about Brazil just a second, and I'll close here. There's been a lot of discussion in the press about, boy, it's gotten dry in December in Brazil. Boy, they're going for a drought. Here we go. We're going to get this big bean rally. So let's back up again, put this in perspective. November was a fairly wet time in Brazil, and they had good subsoil moisture coming into December. So a lot of that moisture is going to be used up in the drier period, and December sometimes tend to be a dry period, and those drier periods tend to be not in Mato Grosso. Southern Mato Grosso has been dry, and Paranon's been dry, but not the major growing areas as you get out into central and western Mato Grosso. So we do see dryness, but we are coming in a period of time where they tend to get a little bit more rain here in January. And also the other perspective on that is keep in mind is we're going early production estimates were that we're going to be 130 million metric tons of soybeans. That's a record. Those numbers now are coming down to around 115 to 120. We're at 120 million metric tons. That's still record production in Brazil. We're not running out of beans. And it's, again, I don't think it is in my mind right now, I wouldn't panic wouldn't be panicked that we're going to run out of beans or this is a big market rally. But if the market wants to give you a rally because they're concerned, oh my gosh, about beans, again, an opportunity to look at your costs and do some marketing going forward into the new year, because you may not get that opportunity again. There's global soybean stocks, and there you can see the record here in the United States. I'm going to stop there. Thank you so much for listening. I know we went through a lot of material here quickly. I'm going to be around all morning, so if you want to talk individually and have questions, I'll be more than happy to visit with you. So thank you very much, and have a good couple days here in Austin.